Standard costing is a method used by companies to estimate the expected costs of producing a product or providing a service. It involves setting predetermined or standard costs for direct materials, direct labor, and overhead, and then comparing these standard costs to the actual costs incurred. The purpose of standard costing is to help businesses budget more effectively, control costs, and assess operational performance. Key components of standard costing. 1. Standard direct material costs. The cost of raw materials required for production, calculated based on a standard price per unit of material and the standard quantity, which is how much is expected to be used in production. 2. Standard direct labor costs. The labor costs required for production, calculated based on a standard hourly wage and the standard time needed to produce 1 unit of product. 3. Standard overhead costs. These include fixed and variable overheads such as factory rent, utilities, and machinery depreciation. They are allocated to each unit produced using a standard overhead rate. Steps involved in standard costing. 1. Setting the standard costs. Historical data such as past performance, industry benchmarks, and expert judgment are used to set realistic cost standards. Adjustments are made periodically to reflect changes in costs, technology, or market conditions. 2. Recording actual costs. Actual costs are tracked and recorded as goods are produced or services are provided. These costs are then compared to the standard costs. 3. Variance analysis. The difference between the actual costs and the standard costs is called a variance. Variances are classified into favorable variance when actual costs are lower than standard costs, and unfavorable variance when actual costs exceed standard costs. Variances can be broken down into material variance, which is the difference between actual and standard material costs, labor variance, which is the difference between actual and standard labor costs, and overhead variance, which is the difference between actual and standard overhead costs. 4. Analyzing and addressing variances. After identifying variances, managers analyze the reasons behind them and take corrective actions. For example, if there's a labor variance due to inefficiency, training or process improvements might be required. Advantages of standard costing. 1. Budgeting and planning. Helps companies plan and set financial goals by providing clear cost expectations for production. 2. Cost control. By comparing actual costs with standard costs, businesses can identify areas where costs are rising unnecessarily and take steps to control them. 3. Performance measurement. Variance analysis helps managers assess the performance of departments and employees in terms of cost efficiency. 4. Simplified accounting. Standard costing reduces the complexity of tracking every single actual cost in detail, making the accounting process simpler and more efficient. 5. Pricing decisions. Helps companies determine appropriate pricing by understanding their cost structure. Disadvantages of standard costing. 1. Inaccuracy of standards. If the standards are not set correctly or are outdated, they may lead to incorrect conclusions from variance analysis. 2. Overemphasis on cost control. Focusing too much on cost control may hinder innovation or the willingness to invest in necessary improvements. 3. Doesn't reflect real-time changes. In fast-changing industries, the static nature of standard costs can be a limitation, as they might not reflect real-time fluctuations in material or labor costs. 4. Potential for misleading variance. If variances are not carefully analyzed, they may lead to misinterpretation of the actual causes, leading to incorrect actions being taken. Example. Let's say a company manufactures widgets. The company sets the following standard costs for producing one widget. Direct material is 5 kilograms of material at $2 per kilogram equal $10. Direct labor is 3 hours of labor at $15 per hour equal $45. Overhead is $20 per widget. The company produces 1,000 widgets and the actual costs are: actual material cost is 5,200 kilograms at $1.90 per kilogram equal $9,880. Actual labor cost is 3,100 hours at $16 per hour equal $49,600. Actual overhead cost is $21,000. Now the company will calculate the variances. 1. Material variance. Standard material cost is 1,000 widgets. Multiply $10 equal $10,000. Actual material cost is $9,880. Material variance is $10,000 minus $9,880. equal $120 favorable, because the actual cost is lower than the standard. 2. Labor variance. Standard labor cost is 1,000 widgets multiplied by $45 equal $45,000. Actual labor cost is $49,600. Labor variance is $45,000 minus $49,600 equal $4,600 unfavorable, because the actual labor cost is higher than the standard. 3. Overhead variance. Standard overhead cost is 1,000 widgets multiplied by $20 equal $20,000. Actual overhead cost is $21,000. Overhead variance is $20,000 minus $21,000 equal $1,000 unfavorable. By analyzing these variances, the company can understand where cost overruns occurred in labor and overhead and take steps to address these issues. In summary, standard costing helps businesses manage and control costs efficiently, but it's important to regularly review and adjust the standards to ensure they remain relevant and useful in decision-making.